everyone, this is Demel Gonzalez of Heartwood Financial Services. Hey, I hope you guys are having a great summer. I know the market's been all over the place and it's been quite negative, so I hope that you can block that and get out there and enjoy your summer as best as possible. Hope everybody had a great 4th of July. It was kind of a quiet one for us this 4th of July. So maybe we're just getting a little old. I don't know. We were in bed before the fireworks are off. But anyways, thanks for joining us. I get into what's going on in the markets, a little bit of what I'm seeing around the corner with inflation, which it could influence the Fed, which could also, of course, influence the markets, and what we're doing about it here at Heartwood. So I hope you guys enjoy. Thank you for being such loyal clients through these trying times. And of course, as always, reach out to me if you have any questions or concerns. Thank you so much. Okay, as always, we like to start off with the asset class returns. And I am sorry to report, but it was a very poor month, the month of June. You can see the blue bars here are all down. There was really no place to hide. It's been a very interesting market because usually when the market's down, you get the fixed income part of the market that holds up a little bit better. But as you can see by the green bars here, the bond market has actually been losing almost as much as the stock market this year. So it's been really a pretty horrible start to the year overall, even with a diversified portfolio. The only part that's really been the saving grace has been commodities, which is over here in the far right. But as you can see, even last month, we're starting to see commodities come down. That could be the sign that we're finally starting to turn the corner on this inflation story, because it has been hot and very persistent. But as you can see all the way around, large caps down about 8, small caps close to 9. Real estate faring a little better. International developed has been off a little bit more. Emerging markets is actually down a little bit less. We're going to talk a little bit more about that in the outlook, about what's changing in China. That could be a good sign. But overall, fixed income down, especially in the high yield markets. So that's the asset class returns for June. Okay, so here is a quick recap on what happened last month, which was the catalyst to how the market reacted. First of all, it's all been about inflation. COVID has not been so much in the headlines anymore. It's been more about the issues with inflation. And the CPI print, which is the Consumer Price Index, came out middle of June, and it came out a little bit worse than expected. We had a nice dip last month, so everybody was starting to get a little bit optimistic about maybe peak inflation, but then it came back up a little bit again. And so it looks like inflation's here, going to be here a little longer. It's a little bit more persistent, not as transitory as a lot of economists hope. So of course, that hurt the markets. The Fed had to react. As you can see, they shortly thereafter raised interest rates by 75 basis points, which was more than they were initially going to do at 50 basis points. So again, the market saw that coming and started to adjust downward. Remember, interest rates is like gravity for the market. More interest rates, higher interest rates, more gravity. It's going to keep the stock market from going up as much and going down a little bit more. So now we are officially in a bear market. Anytime we're down by more than 20% from the peak, which was around the beginning of January, we are officially now in a bear market since we're down a little bit more than 20%. All right. And lastly, now the probabilities of recession are going higher. In my previous videos, I've talked about maybe a 50-50 probability. I think we're now looking at more like a 60-70% probability. It's not inevitable, but it's probably the highest case scenario. Now, recessions don't mean that they have to be like 2008 all over again. it could be a mild recession, and I still think that is my base case, that we will just see a slowdown with a mild recession, which is probably what we need to get the inflation problem under control. So we'll see, and I'll talk a little bit more about the recession ramifications here in the next slide. Now, for those of you that saw my mid-month letter that I sent out, this will be a little bit of a review, but I wanted to show this again because it's I think it's very important to understand what a stock market looks like during a recession that's not 2008, because that's basically the last one most of us can remember. And as you can see here, obviously there are declines, and the average is around 32% or so. And so with us being down right now around 23% negative, you could see that we're basically 2/3 of the way there. Basically less than 10%. Now, you might say, well, that's still a lot, Demel, but at this point, it's almost like where you're too late to sell and maybe a little too early to buy, because we're seeing that the inflation problem still hasn't been resolved and the Fed is still raising rates, and that's usually not the best time to jump in. But it seems like it's getting pretty close, and it's hard to say how bad this recession is going to be, of course. I think it'll probably be more in the milder types of recessions. So if we look at a milder type of recession where maybe we're down 25, 27 with the market, we're pretty much there. And so I see this kind of as an encouraging sign, and I do see that the recession, even if it's mild, could finally really lick this inflation issue that we've been having. Okay, so now we got the update for June out of the way. Let's talk about what the rest of the year could look like, right? That's always the most important piece to try to evaluate. So I'm summarizing this into a few pieces here. You're seeing, first of all, consumer spending. It's starting to look like it's slowing down. It's not negative yet, but it's going down significantly. So we're starting to see the signs of that recession. And the reason I'm highlighting consumer spending is because, again, the consumer is 70% of the economy. So if the consumer is starting to slow down, you're going to see the economy significantly start to slow down. Commodities starting to come down. We talked about that a little bit in the asset class returns. Commodities is essentially what makes up of all the stuff, that goes into goods, and a lot of times into services as well. So as that starts to come down, that's going to help bringing down inflation. China easing restrictions. Okay, I pointed that out a little bit in the emerging market returns and showing a little better sign than the domestic counterparts. Well, we'll talk a little bit more about that. And inflation expectations measured by the break-even rates. This is where the bond market is looking at TIPS versus regular types of bonds, and the way they're priced is the anticipation of inflation over a certain period of time. We're going to look at the 5-year rate and how it's been coming down as well. And then lastly, I'll talk about what implications that would have here for the next several months. Thanks. All right, so we're going to start off with the outlook on bad news is good news. And what does that mean exactly? I mean, usually bad news is bad news. But in this case, since it's the Fed that has induced this slowdown and potentially a recession, if the Fed sees the market, or the economy I should say, starting to slow down, that means that what they're trying to do is getting done. And that's good news, because if they don't see that things are slowing down by them raising interest rates, which is their way to try to slow things down. Remember, they can't control Putin and they can't control OPEC, but they can control the U.S. economy and potentially slow it down. So that's their way to fight inflation. So when they see the economy start to slow down, they feel like they're accomplishing their goals of fighting inflation. So that's what I mean by bad news is actually good news, which means that they may not have to do too much more in the forms of raising interest rates, which means that they might be getting closer to not having to raise rates anymore. You see what I'm saying? So this could actually be short-term bad news, but long-term good news. All right, you heard me talking about this in the asset class returns. Commodity prices, they've been going up. That's what all of our stuff is made out of, right? Wheat and oil and corn and copper and all this stuff. So I have 4 examples here: crude oil, lumber, copper, wheat. And I know I made the charts kind of small because I just wanted you to see the trend. You could see the trend in crude oil has been up, but recently you're starting to see a dip here. And that's actually been the case even since I put together these charts. It's continued. Lumber has been on a trend down already for quite a while. Copper, you're seeing the same thing happen there. It's had a few bumps, but it's been mostly down. And now we're also seeing the same thing with wheat. So basically what's happening is transportation, food, looks like it's hit its peak and is maybe on its way down. Is that because of the slowdown in the economy? It's hard to say. It could be a combination of both things, getting a little better supply side wise and the economy. I suspect it probably has more to do with the slowdown in the economy because the issues that we're having with supply with oil and wheat and what's going on in Ukraine and Russia has not improved. So it's mostly on the demand side. So again, the Fed is starting to get what they want in lowering these commodity prices. So maybe we're starting to get close to peak inflation, as you can see here. Now here's another part of the story that really hasn't been on the news very much. By the way, the news, they don't always like to tell the good side of the stories, do they? They love to emphasize the worst case scenarios and get that fear, that fear level up. That's what keeps us watching. So you got to remember that when you watch the news. So on the flip side here, I wanted to show you that China is starting to ease restrictions. And a little different from what I thought. I thought maybe they would ease and then they would go back. And I'm starting to get the impression that the Chinese government is really feeling the pressure from an economic standpoint, especially since President Xi is up for re-election this year. So just like the elections here, he wants to look good going into the election. So I think they're going to really fight this zero COVID policy and start easing things more. And even if the numbers go up, they probably just won't report them, knowing them. Sorry, my opinion. But my point is those COVID restrictions are going to start easing. And with China's COVID restrictions easing, that means global output's going to increase, demand from China is going to increase, all good things for the global economy. And this might be what saves us from a recession globally, especially here in the U.S. Maybe not Europe. Europe might be destined for a recession pretty much no matter what, unless Putin decides to turn around and leave tomorrow. But at least for the U.S., this could be the silver lining that's not really being talked about a lot. All right, and last chart, this is the 5-year break-even inflation rate. So at the start of the outlook, I mentioned how the bond market is looking at TIPS versus regular, they call nominal treasuries. It's basically the bond market predicting inflation, and this is the inflation over the next 5 years. You could see that inflation expectations went up above 3.5%. Sorry, it might be a little small, so you just take my word for it. But you could see how the slope has been coming down. And so again, that's probably because slowdowns occurring, probably not because supply side stuff is getting much better, although that might be coming, especially with the China ease. But this is probably because things are slowing down. So again, that's going to help the inflation expectations. And so if we can start controlling and getting those inflation numbers down, my whole point to this is the Fed will start to let off the brake a little bit. And as soon as they start letting off the brake just a little bit, the stock market could very easily have a little bit of a relief rally, because that means that maybe the Fed is getting close to the end of their tightening. All right, so what does this mean for your portfolio? What does this mean for the market going forward? Well, first of all, I want to clarify that just because inflation is peaking doesn't mean that it's going to go back to where it was in 2019. The issues that we're having with Ukraine and Russia are not going away, unfortunately, anytime soon. The China easing, that could take a while to finally start trickling down through the supply chains. And so what I see happening is inflation may stop going up, may plateau a little bit, maybe even go down, but it's still going to stay elevated. So with that being said, we're still going to want to have exposure to commodities. So I am starting to take a little money off of that, some of the gains that we've made over the last year, but not getting rid of all of our holdings in those areas. And I'm mostly staying neutral to the portfolios, to the risk benchmarks, maybe taking it down a notch a little bit, but not too much. Staying with the bonds, making sure we have proper bond exposure, because I think interest rates have probably peaked and are starting to come back down as the Fed has been slowing things down. And so it's basically a similar story to what I gave last month, other than just making sure we're getting to that neutral asset allocation with all the portfolios, and really hoping to see, and looking very closely at those CPI numbers to see if the Fed is actually really getting the slowdown that they want. And if it's too severe of a slowdown, or if it's just right of a slowdown, we'll have to be paying very close attention to. That's a very hot debate right now in the markets, to how severe that could be. But in my camp, I think we'll have a mild recession, maybe have a little bit more downside to go, unfortunately. Earnings that are coming out in the next month will probably not be great. And I think a lot of companies could start what I would call kitchen sink some of the bad news into this report. But that means that maybe after this month and a half, we could see the light at the end of the tunnel and could have a very nice comeback through the end of the year if we do see that inflation peaking and starting to settle down. So the message here is hang in there. We're doing everything we can without timing the market. I don't know what the future holds. We can only make our best estimates based on our research and try to position that way without getting too cute, without getting too arrogant in what we think is going to happen. Always hedging and doing it incrementally. And so I hope that you guys understand that that's always been my strategy and my style. And that's what we'll continue to do. So thanks for watching. I hope this was helpful. And please reach out to me if you have any questions or concerns. I know it's been a very trying market here for the last several months. Thanks again.